When you're picking a stock to invest, it's not about guessing, it's about understanding the business behind the ticker. In this video, I'll walk you through my personal framework for analyzing a company before I buy the stock. Let's dive in. Short note, the link with whole process is in the link below in description, so check it out. It's free, just wanted to share it. Step 1, understand the business. First I ask, what company actually do? What are its main products or services and how does it make money? I break revenue into segments, for example, hardware, software, and services, and look at which one are growing fastest. Then I look at the geography. Is growth coming from the US, Asia, Europe, or other countries? Geography expansion often shows where management sees future opportunity. Step 2, management and strategy. Next, I focus on the people running the company. Can I trust them to execute their plans? I look at their track record and how clearly they communicate the strategy. I also pay attention to their KPIs, what they promise to deliver, and check whether those are realistic compared with competitors and analysts' expectations. Step 3, analyze financials. Now, numbers. I start with revenue and net income growth over the last few years. I also check operating margin, which is operating income divided by revenue, because it shows the company core profitability. I always review free cash flow and make sure the balance sheet looks healthy. Total assets should exceed liabilities, and ideally, when current assets are higher than total liabilities, that tells me that the balance sheet is really great. Also, important thing is shares dilution. I don't want company constantly issuing new shares and reducing my ownership percentage. It's only acceptable if the company is in very active growth and are not earning money yet. Step 4 is valuation metrics. Once the business looks solid, I move to valuation. Basically, what I'm paying for that growth. For profitable companies, I have a rough guideline for you. For example, if company grows under 5% per year, I usually look at PE ratio. It's one of the valuations it really matters for me then. If they're growing so slowly, I usually want to have PE under 20. But if company grows above 5%, like 6, 11%, I usually look forward PE below 25. If they grow from 12 up to 20, I usually look forward PE under 30. And if company grows over 20%, I usually look into the forward PE about 35. For unprofitable companies, I look whether they can become profitable within the next 3 to 2 years based on their revenue trends. I also am checking free cash flow if it is becoming less negative or even positive. The other valuation metrics I'm watching is price to sale ratio. Lower is better usually. Price to free cash flow. I prefer usually below 15-20, but it's really depends how fast company is growing. If company is growing over 20% yearly, maybe it can be even 25. Yeah. I'm also paying attention to the gross margin. I really like when companies have this 50-60% gross margin or even above. That means probably that there are no much competition and they can take more money from the client. That means that this company really has a moat. Another thing I'm watching is ROIC, return of invested capital. I usually prefer to be above 10, 12. Higher is better, definitely, because we don't want to have a return of investment like 20 years. Yeah, definitely we want to have return of investment into 5, 3, maybe sometimes 7 years and so on. Yeah, but faster is better, definitely. So the higher number is better here. After numbers, I summarize everything in the SWOT analysis. SWOT analysis is with defining strengths, weakness, opportunities, and threats. It gives a clear visual of whether the company has a sustainable growth story or too many risks. When I'm making this analysis, I also compare competitors. I am checking if my company, which I am interested to invest in, is stronger than competitors. Are they growing faster? Do they have a better balance sheet? What risks they have comparing to competitors? And so on and so on and so on. Yeah. Next, what I want to tell you where you can take these balance sheets and valuations. For valuations, I love really to use Finviz. It's a very old website, but the data is always updated. They have multiple analyst predictions and so on. For the earnings, best thing is to watch SEC Feelings 10Ks of company or 10Qs, its quarterly reports, or you can just go to the website of investor relationships of the company you are interested in and check financial reports and presentation of the last quarter. There are multiple different sources where you can watch financials and valuations. For example, I love TradingView as well because it has such comfortable area where you can navigate between the balance sheet, financials, and everything that I just enjoyed. Of course, I better recheck it in the original documents, but overall, for fast review, TradingView is a great place to be. Step 6 is checking analysts. It's not mandatory thing, but I will better check it out and will be sure that my valuation bull and bear case are at least somewhere not too far, because maybe I have made a mistake or maybe I missed something, and then it can go to deeper analysis. So really better to check it just to be sure that you didn't miss something. So that is a short version of my approach. Of course, it's much more detailed when we're talking about the full version, but main thing, understand the business, trust the management, analyze the numbers, compare valuation, then summarize with SWOT and check with competitors. If you apply this strategy consistently, you'll start seeing which companies truly deserves your investment, not just hype. Just short note, all the process is described in the Notion link in the description, so check it out. If you found this helpful, hit like, subscribe for the next episode, and remember, keep growing.